Are you nearing retirement age and still struggling to reach your savings goal of $1 million? You're not alone. According to a 2020 survey by the Employee Benefit Research Institute, nearly 70% of workers in their 60s have less than $100,000 saved for retirement, leaving them woefully unprepared for the financial demands of aging. But there's one thing that's keeping you from reaching your goal. It's not a lack of knowledge or motivation. It's something much more insidious. Something that affects millions of Americans every year, regardless of income level or education. I'm talking about inflation, and how it erodes the purchasing power of even the most robust retirement savings. Inflation is a silent killer of financial security. Since 1970, inflation has averaged around 4% per annum in the United States. That may not sound like much, but trust me, it adds up fast. For instance, if you're saving $50,000 at 3% interest and inflation is running at 4%, your returns are being eaten away by a whopping 7% difference. That's money that could be going into your pocket, but instead is getting lost to the ravages of inflation. Let's look at some real-life examples. Imagine you're saving $10,000 per year for retirement, and you're earning an average return of 5% on those savings. Sounds like a solid plan, right? But what if I told you that due to inflation, your money is actually losing value by 4% every year? That means your hard-earned savings are decreasing in real terms by $400 per year. Now let's talk about the impact of compound interest. We all know it's powerful, but few people understand how it works in practice. For example, consider a 30-year-old who starts saving $5,000 per year for retirement at a rate of 4% interest compounded annually. By age 65, that person will have saved over $700,000, impressive, right? But here's the thing, if inflation is running at 3%, their savings won't be worth nearly as much in real terms. In fact, according to a study by Vanguard, a retiree who earns an average annual return of 4% but faces inflation of 3% will need to save significantly more just to maintain their purchasing power. To give you a rough idea, let's say our hypothetical retiree has saved $1 million at age 65 and is earning an average return of 4%. However, with inflation eating away at their returns, they'll actually be left with less than $700,000 in real terms, just to break even. This brings me to the first key takeaway: inflation is a silent killer that eats away at your purchasing power. It's not something you can simply ignore or wish away. You need to factor it into every investment decision and savings plan if you want to reach your retirement goal of $1 million. Let's move on to Section 2, the dark side of high-risk investments. High-risk investments may offer high returns, but they also come with a higher price tag, namely, the risk of losing everything. Consider the case of John DeWitt, a retired firefighter from California who lost his entire $1.5 million retirement account in the 2008 financial crisis. His portfolio was heavily invested in high-risk stocks and real estate, which tanked during the Great Recession. DeWitt's story is a cautionary tale for anyone considering high-risk investments. With inflation rates soaring and market volatility on the rise, it's more important than ever to strike the right balance between risk and reward. You see, most people don't realize that even conservative investors can lose money if they're not diversified or if their investments are heavily exposed to a particular asset class. Take bonds, for example. While traditionally seen as low-risk investments, some bonds have lost up to 50% of their value in recent years due to rising interest rates and defaults by borrowers. So what's the solution? It's simple: invest wisely. Diversify your portfolio to minimize risk, choose funds with a proven track record of stability, and always keep an eye on inflation. In Section 3, we'll explore the hidden costs of fees and commissions. Fees and commissions are another silent killer that erodes the value of your retirement savings. Did you know that the average mutual fund fee is around 1% per annum? Sounds like a small price to pay for investment expertise, right? But when compounded over decades, those fees can add up to tens or even hundreds of thousands of dollars. Consider the case of an investor who puts $10,000 into a fund with a 2.5% management fee. Over 20 years, they'll lose around $23,000 in real terms, money that could be going towards their retirement. And don't even get me started on commissions. According to a study by the Securities and Exchange Commission, SEC, some advisors charge up to 3 times the annual fees of a low-cost index fund. So what's the solution? It's simple: shop around. Look for no-load funds, ETFs, or index funds with lower management fees. Use online resources like Morningstar to research and compare investment options. And always keep an eye on your account statements; those hidden fees can add up fast. In Section 4, we'll examine the role of tax-efficient investing in maximizing retirement savings. Did you know that taxes can eat away at nearly half of your retirement income? It's a staggering figure, but true nonetheless. That's why tax-efficient investing is crucial if you want to reach your goal of $1 million. Consider this: an investor who saves $10,000 per year for 20 years and earns an average return of 5% will have around $350,000 in their account at age 65. Impressive, but not nearly enough to last a lifetime. However, if they can optimize their portfolio for tax efficiency, they might be able to increase their returns by up to 50%. That's the power of compounding interest. To achieve this, you'll need to use strategies like tax loss harvesting, municipal bonds, and Roth IRA conversions, all of which require some expertise. But trust me, it's worth it. Every dollar saved is a dollar earned. Finally, let's talk about Section 5, the power of behavioral finance. Behavioral finance shows us how our psychological biases can lead to costly investment mistakes. We're talking about the sunk cost fallacy, throwing good money after bad, the fear of missing out effect, buying into a hot stock without doing your research, and the confirmation bias, only seeking out information that confirms your preconceptions. Consider the case of an investor who's convinced their portfolio is underperforming due to market volatility. They start making emotional decisions, selling stocks at the bottom of the cycle or buying into overpriced assets, both of which can lead to huge losses. The solution? Stay disciplined. Use tools like dollar-cost averaging to smooth out your investments and avoid timing risks. Automate your savings by setting up a regular investment plan. And most importantly, educate yourself on the basics of investing and finance. Knowledge is power. In conclusion, reaching $1 million in retirement savings requires discipline, patience, and a solid understanding of the key factors that affect our wealth. From inflation to high-risk investments, fees and commissions, tax-efficient investing, and behavioral finance, every one of these factors can make or break your financial future. So what's the takeaway? You need to be proactive about managing your retirement savings. Don't wait for the market to recover or for the perfect investment opportunity to come along. Instead, use these strategies to maximize your returns and minimize your risks. It's not rocket science, but it does require effort and commitment. You see, reaching $1 million is a marathon, not a sprint. It takes time, discipline, and a willingness to adapt and learn as the market evolves. So go ahead, take control of your retirement savings today. Start by implementing 1 or 2 strategies from this video into your investment plan. Monitor your progress regularly, and don't be afraid to make adjustments along the way. Remember, every dollar saved is a dollar earned, but it's also a chance to build financial security for yourself and your loved ones. Don't let inflation, fees, commissions, taxes, or behavioral finance stand in your way. Take control of your future today.